Okay, so it's 7 o'clock. Let's get going. My name is Sam Wylie. Welcome to this webinar, AI is it a bubble? This is one of a series of webinars on macroeconomics and the macro economy and how investing fits into that. I usually run one of these about every 6 months. Usually when my investments course is coming around, I remember that I should run a webinar. And so the possibility that AI is a bubble, like the dot-com bubble, has really been exercising people's minds. So here we have a webinar on that. Now, I should just say before we get going here that if you have any questions, we're going to go for about an hour. We'll go from 7 o'clock till 8 o'clock. Maybe we'll go a little bit longer than that. I am a bit notorious for going over time. So perhaps we'll go a few minutes over 8 o'clock, but then I'll answer your questions. So if you've got any questions, please write them in the chat. I can only think about one thing at a time, so I can just think about what I have to say here, and then I'll think about your questions once we get to that. So if you've got any questions, write them in the chat. I'll try and answer all of your questions once we get into that. Okay, these PowerPoint slides that we're going to use here, we'll send you a copy of the slides. We'll send you a link to the video in a day or two. So AI, is it a bubble? So here's the issue. On the 17th of March 2023, about 2.5 years ago, the ChatGPT-4 was released, and you can see that AI had been an evolving issue before that in terms of the valuation of the S&P 500 and other stock markets, but especially the Nasdaq and the S&P 500. But ChatGPT-4 opened a new chapter, and the market is up a lot. It's up 65% since that point. It had been going up coming out of COVID. It had gone down when the inflationary impulse from COVID got going and interest rates started going up, and then it started heading up. And the question that people have, this part here, of course, is Trump's tariffs and the Liberation Day tariffs, which we recovered from. And the question is this a bubble? Is the valuation so far above fundamentals that could really drive the valuation? Is the valuation so high that we've got a bubble? And people are especially, as I said, comparing this to the dot-com. So here's the questions we're going to address in this webinar. We're going to talk about what AI is briefly and how big is it? Because look, it really matters how big AI is when you're comparing it to a bubble, you've got to think about how large the opportunity is to compare the valuation to. If you don't think AI is a very big deal, if you think it's really just a continuity or a continuation of the evolution of computing that started after the Second World War, then if you don't think it's a very big deal, then you will think it's a bubble. You'll think that people are getting too excited. If you think it's the biggest thing since the invention of fire or writing, then you won't think that it's a bubble. And we're going to talk through where it is in terms of its size. But we have to compare it to that background notion of how big a transformation AI actually is. And so we're going to get into that. What's the scale of AI? And then we're going to talk a little bit about what bubbles actually are, or how bubbles form, or what are really the necessary conditions for a bubble to occur. So when do asset price bubbles form? We're going to talk about what price bubbles are, what are the necessary conditions for them, and look at whether those conditions hold here. We're going to look at some examples, the property market.com, the GFC. Then we're going to look at some valuation fundamentals. We're going to see that the conditions for a bubble to occur actually do hold in this case. And then we're going to look at some valuation fundamentals. Is the valuation of the S&P 500 and Nasdaq so high that we really think that a bubble is what pertains at the moment? Now, I'm going to argue that it isn't so high. It's nowhere near as high. Those kind of valuation figures aren't nearly as high as they were during the dot-com bubble. And when we get into a simple valuation model, you'll see that under reasonable scenarios, then the valuation can be justified. But it still is high by historical standards, and so we need to have some caution. Now, I'm going to talk a little bit about economic considerations, and these are the things that we need to exhibit caution about. We'll talk about President Trump and the Fed. President Trump's attack on the Fed, and I don't mean to have a go at President Trump here, I genuinely mean that, but President Trump's attack on the Fed, first of all on the chairman of the Fed, Jerome Powell, and now on one or two members of the Fed, eventually the market is going to revolt against that. And when it does, there's a danger that push back against that, and eventually, and when it does, there's a danger that the stock market goes down. We'll talk a little bit about the capital intensity of the Magnificent Seven firms, the Mag 7 firms, because firms that invest too much in capital, in capex, capital expenditure, typically deliver low returns. That's been the historical norm. And we'll talk about AI slowing down as well. These are things to worry about. And the reasons why you should be cautious, and we'll talk a little bit about what to do in that regard, and then we'll get into what your questions are. So just a little bit about me. I am an academic who's become a consultant. So I went to UWA. That's where I met my beautiful wife, Tracy, who's actually sitting just over there and running this. I went to the ANU. Tracy and I both went to work for Canberra. She worked for the Prime Minister's Department. And I worked for the federal government as well. I did a master's degree at the ANU part-time, won a scholarship from Solomon Brothers to go to London Business School, as you can see here. Did my PhD there. Went to, as a junior faculty member, as a junior professor to Dartmouth University in the States, Ivy League University in the States for quite a long time. Came back and I've been at the Melbourne Business School since then in the finance faculty. And this is what the Melbourne Business School is going to look like. Those of you who've been there, which will be a lot of you, know that it doesn't look like that yet, but that's what it's going to look like once we raise the money. And that's actually happening amazingly quickly with our new Dean, Jenny George, who was previously the Dean, so our new old Dean. Now, these are companies I work for. As I said, I do quite a lot of media, especially YouTube. You should check out my YouTube channel. Work for a lot of companies, but nowadays I mostly work on wealth management for families that have different levels of wealth, consulting to family offices and ultra high net worth up here, running my investments course for people more in these strata. Okay, let's jump into this question of what is intelligence. This is an attempt to understand what we mean by AI. And I'm going to divide this into 4 quadrants and fill them in one at a time. Now, here we are. This is where we are with artificial intelligence at the moment. Artificial intelligence is able to generate what we should do next. This is the sense in which it's generative. It'll generate the next move in a game of chess, or generate the next thing that should be actuated in driving a car. Should we put on the brakes? Should we push down the accelerator? Should we turn the steering wheel, etc.? What's the next thing that needs to be done? What's the next token that needs to be created, or the next word? What's the next word that needs to be said? Well, I don't know. But in any case, that's all of these are like that. What's the next question that needs to be asked? What's the next thing that needs to be done to follow rules? This is where artificial intelligence is up to at the moment. It's generative artificial intelligence. It's not general artificial intelligence. So general artificial intelligence is more in this vein of strategy and planning and coordination. And these are the things that artificial intelligence can't do, but people are expecting agents to be able to do as we go along, as we evolve, as artificial intelligence evolves and develops over the next 10 to 20 years. Now, I think there's quite a lot of hype about how much of this will be done quite soon and how much of the sort of white-collar part of the workforce will disappear as a result of that. Look, if this part here, the simple following of rules, I think that part is essentially going to be taken over by AI. But AI's ability to do things like plan a sales, look, it'll come up with a plan for it, but to actually execute and to do things that take judgment and complexity, and especially the sort of the handling of exceptions here. That's where we're heading with AI, but that is a long way from where we are at the moment. And an even harder problem, which is a part of general artificial intelligence, is these things. These parts of what management do: team building and motivation and communication. Down here, a lot of this is sort of analytical intelligence. This doesn't really, in a sense, involve intelligence at all. It's just the next thing. But down here, we're looking at analytical intelligence, what people would call IQ. And up here, we're looking at sort of emotional intelligence, what people refer to as EQ. But these things go together to be generalized artificial intelligence. And this is where we're heading. But AI isn't very deep into this at all. I mean, it's certainly true that AI can influence things, including in politics. And we saw that in the 2016 campaign through Facebook, US presidential campaign, of course. And there is there is an amount of ability of algorithms to influence things, but we're still really over here in that regard. It's not the sort of the kind of sophistication that human intelligence has. And down here, once artificial intelligence gets down to here, then it's really all over in a sense. Once AI can produce more AI, then we're going to be entering a singularity. But I would say we are here. We are heading into these dimensions over the next 10, 20, 30, 40 years. We don't know how long it'll take, but we should be conscious of the maxim that technological change, two things. One is that the only thing you know about people's predictions about technology is that they'll be wrong. That they're always wrong. And so, you'll be thinking that about the predictions that I'll make as we go along here. But the second really important maxim is that technological change takes longer than people think. But when it arrives, it's more transformative than they think. I mean, just think about self-driving cars, which are actually they're the top left-hand quadrant of what we were looking at just then. They're really generative AI. What's the next thing to do? What's the next thing the car should do in taking you from point A to point B? Well, Elon Musk, who's one of the best engineers that's ever lived, he thought, although a little bit given to overstating things, he thought that self-driving cars would be fully automated and be a significant part of the car fleet, the global car fleet, by 2018. And now it's 2025. And of course, that hasn't happened, and it's a long way off. That's just an example of technology taking longer to arrive than people predict. But it's also true that people underestimate how transformative that'll be to society when it eventually does happen. So look, I think that those quadrants we were looking at are going to take longer to arrive than people think, but they will be more transformative than people think when they do arrive. Okay, now the next thing is, and this is about framing how big AI is. And I said that at the beginning of this talk, that if you don't have a sense, or if you don't have a position on how big a transformation AI is, then you can't say whether it's a bubble or not. I mean, when you look at the current valuation of the S&P 500 at 6460, and if you thought that AI is just nothing, right, that it's just a continuation of the development of computers, then you definitely think it's a bubble. If you think that AI is the biggest thing ever, then you think it isn't a bubble. And so it really is that backdrop. And there's no avoiding taking a position on this, how transformative AI is going to be over the next 10, 20, 30, 40 years. There's no avoiding taking a position on that, informing your view on whether the US stock market is overvalued or not. Now, look, this US stock market is not the only game in town, but it's certainly the biggest game in town. We'll talk about that a little bit later on as we go through the talk. But there's no avoiding taking a position. And here I'm just trying to give you a framework for thinking about the different positions that you could take. This is one way of thinking about it. One possibility here, and I'm going to go from left to right here into notions of AI being more and more transformative. So you might think that AI is just a continuation of the development of computers since the Second World War. We used to have vacuum tubes, then we had computers built around vacuum tubes, ENIAC. Then we invented the transistor in 1948, Shockley and the other guy. And then integrated circuits with the space program, microcomputers, the internet, apps, big data, large language models. It's a continuation of what's been going on over the last 80 years. This would be, you think that it's a bit of a yawn and that it isn't really a very big deal and that it's overhyped if you positioned it as being a continuation of what's happened over the last 80 years. If you position it as being a continuation of what's happened since the beginning of the Industrial Revolution, then you think it's a much bigger thing. In the Industrial Revolution, we had in the 1780s canals and then the first deep mines, which were being pumped out with steam engines, steam power, railways, chemical processes, the volume creation of steel, internal combustion engines, which have so transformed the world, electrification in the first half of the 20th century, computing, biotech. And here you would think that AI is as big as the internet. If you thought that it was a part of this continuation of the Industrial Revolution, a subset or a component of the Industrial Revolution, you'd be framing it in what's been happening over the last 250 years. Now, a step up from that is to give it a much bigger role, is to say that you think that AI is as big as the whole of the Industrial Revolution, and that you're framing it not as a component of what's happened over the last 250 years, but you're framing it, what's going to happen over the next 40 or let's say 50 years, as a component of what's happened since the dawn of civilization. As big as these things, writing and the Middle Ages and empires and mathematics and the scientific method. This might be the biggest thing that's ever happened to humans, the scientific method, but you think it's as big as the whole of the Industrial Revolution, but instead of playing out over 250 years, you think it's going to play out over 50 years. That's how you would frame it. And in that case, you would think that it's a really very big deal. But look, there's higher levels than that. I'm going to put a line through this. I think that people who think that AI is just a yawn and just an extension of what's been going on since the Second World War are really are not being realistic. So I'm just going to put a line through that. But there are levels beyond this, right? You might think that AI is a component of the whole of the human story. I mean, humans have been around for about 300 years. Of course, there were hominids before that, but you might think it's as big as these things about the invention of tools, and of course, there were hominids who used tools before humans. There were even hominids who used fire before humans, but we're certainly the only hominids, Homo sapiens, that have language or any of these things, any of these massive things. If you stepped it up, you would be thinking that AI was as big as these things. And of course, let's just take it to the maximum. You might think that AI is the gateway to the, and here I'm just sort of framing just taking this to the absolute limit. You might think that AI is something to think about in the whole sweep of life, and that AI is really the gateway to the transition to another form of life along this pathway. Now, I'm going to put a line through that as well, because I think that's just science fiction. And let's go back to this. Let's go back to the 250 years, 5,500 years, and the whole human story. Look, I think that we are here. So maybe you think we're over here, or that we're over here. I think that it's as big as the whole of the Industrial Revolution. So I'm just telling you how I'm framing it. I think that AI will be as transformative as the Industrial Revolution over the next 40 or 50 years, but it'll play out over 40 or 50 years instead of over the 200 to 220, 230 years that the Industrial Revolution's been going. It'll be highly just transformative, highly, highly disruptive. You know, that means we're in for a wild ride. It means two things. One, a lot of volatility and a very wild ride with all of that transformation. It's not clear that we'll be able to handle all of that. It didn't go super well in the Industrial Revolution. You know, in the Industrial Revolution, we had, many fabulous things happened in the Industrial Revolution. I don't mean to be too negative, but we also had the colonial era. We had people working down in mines. You know, we had industrial scale warfare come along. We had industrial scale destruction of the environment in the Industrial Revolution, and of course, we had the birth of democracy and billions of people exiting poverty. So I'm not pretending that the Industrial Revolution hasn't been fabulous for humanity, but a lot of rough stuff's happened as well. And that's going to be compressed from 250 years down into 40 or 50 or 60 years. So it's going to be a wild ride, but a vast amount of wealth is going to be created as well. Anyway, look, I don't mean to overstate this. What I'm really saying is that you can't think about whether the US stock market, which is really the epicenter of investing in technology and AI, everyone knows that, and they will go on for the foreseeable future. You can't frame a view of whether it's overvalued or not without taking a position on how transformative AI is. And I'm just trying to give you a framework for choosing, you know, one of those. It's the frame of time over which you think AI fits into. Is it the last 80 years, the last 250 years? Is it the last 5,500 years, etc.? So choose yours. Mine is this. I think it's as big as the whole of the Industrial Revolution. What's going to happen over the next 40 or 50 years? Okay, now I want to turn to something else, which is to talk about what bubbles are, what efficient markets and bubbles are. In a way, efficient markets and bubbles are really the opposite of each other. And they're the opposite of each other in the sense of the flow of information. So let's say that we are investing in something. Maybe we're investing in US stocks. We're investing in the S&P 500, or we might be investing in a single stock. We might be investing in Nvidia or Amazon or Tesla or something. And what we have here is people who have a positive view. You know, the market is made up of bulls and bears. So we have people who have a positive view of the market, and their buying pressure will drive the price up. Over time, as their positive view develops and they create more and more demand, more and more buying pressure, the price will go up. And that'll be matched by people who have a negative view. And if the market is efficient and open, then both of these views can be expressed. And we will get to a price which reflects both positive views and negative views about the true value of what it is that we're trying to value. Maybe we're trying to value a piece of property. Maybe we're trying to value a company. Maybe we're trying to value, a whole market like the S&P 500 index or the ASX 300 index. But there will be positive views and negative views. People will have different information and they'll have different subjective processing of that information. And it's also true that there'll be an amount of difference in risk aversion, etc. But there will be bulls and bears. And if their influence comes to bear, if both of them can bring their influence to bear, then we will get to a price that reflects all of the information in the market. And the faster that this happens, that these views come to change the price, then the more efficient the market is. That's the notion of efficiency, how efficiently new information becomes incorporated into the price. Now, in some markets, that's a well-working market where we have full information value. So it's like the opposite of a bubble. But sometimes the negative view gets blocked. Now, this is a circumstance in which bubbles occur. This is almost always true, that a bubble can occur because the positive view can come to bear because people can always buy, but people who have a negative view may not be able to express that. And sometimes that happens. The most likely way that happens is because people who don't own the asset can't sell it. For instance, let's just take an example here, and this will sort of show you what I mean by short selling as well. I know most of you know what short selling is, so I'll just be very brief in my description here. Let's just take this very simple example. Let's say that you think that BHP shares are overvalued at $40. They're actually at $42.20 today. But let's say that BHP is at $40 and you think it's overvalued at $40. And you want to act on your negative view or your negative information about BHP. Now, if you own BHP shares, what are you going to do? Well, you're going to sell your BHP shares, and that will put downward pressure on the price, and your negative view will have come to be incorporated into the price. But what if you don't own BHP shares? What are you going to do next? Well, in this well-functioning market, you can borrow BHP shares. This is what it is to short sell. You can borrow BHP shares and sell them into the market. Now, what will your balance sheet look like? Well, you'll owe someone 1,000 BHP shares. You borrowed 1,000 BHP shares, and you'll have $40,000 in cash because you sold the shares. Now, a custodian will hold on to the cash, but we don't need to worry about the details here. You have borrowed 1,000 shares and sold them. So you've got 40,000 in cash. Now, your prediction that BHP shares are going to fall comes into reality. And then what do? Well, you buy the shares back at $30 to discharge your liability. You use 30,000 of your 40,000 to buy the shares back. And now you've discharged your liability and you've got $10,000 left over. So you thought that the share price would fall from 40 to 30. You wanted to profit from that. You borrowed the shares, you sold them into the market, you bought them back later, and you made $10,000. That's what it is to short sell. But sometimes, in a lot of markets, short selling is blocked. And when short selling becomes blocked, then negative views can't become expressed. They can be partially expressed because people who own the asset can sell it, But there's a lot of people who have a negative view who don't own the asset. And their negative view can't be incorporated into the price. Now, this sounds like a sort of a technical idea, but this is a real condition, a real requirement for bubbles to form. Most bubbles that have ever formed in asset markets have formed in property markets. Property markets are really, it's well known that property markets are given to the formation of bubbles. And a big part of that is if you think that apartments in Sydney are overvalued at the moment, well, what are you going to do next? Well, if you own your apartment, you might sell it. Probably you won't, because there'll be some capital gains. You don't want to realize the capital gains. And also the round trip cost of selling and then buying back in is going to be something really large. Just the stamp duty alone will be sort of 5 or 5.5%. So there's the transaction costs. But putting aside that, if you think that the apartments in Sydney are overvalued and you don't own an apartment, then what are you going to do? So you have a view that you want to act on, but how are you going to act on it if you don't own an apartment? Are you going to short sell it? Are you going to borrow an apartment from someone and sell it into the market? Of course you're not. It's impossible. There is no short selling. People who have a negative view about property markets and don't own the property in that market can't act. It's not even that easy for people who do own the property to act because of transaction costs, like I said just a moment ago, and also the realization of capital gains, the early realization of capital gains. But people who don't own the property cannot act. They're permanently blocked. And if there is a big divergence of opinion, and some people are very bullish and some people are very bearish, and the bearish opinions are blocked, then the bullish opinions can push, their buying pressure can push the price above its fundamental value. Now, that sounds like a technical idea, but it's just a fundamental requirement for a bubble to occur. Because if this is always open and easy to act on, bubbles will get burst. And that's actually what does happen. Now, let me just show you something else just before we go on here, which is that it's more likely that a bubble will occur when there's highly divergent opinions. And that's what we have at the moment with AI. We have highly divergent opinions about how big it is. But let me come back to whether we are blocked here or not in just a second, and go to some other examples. We were talking about the property market just a moment ago, but let's have a look at what happened in the dot-com bubble. So this is the era from 95 through to March of 2000. It was in March of 2000 that the index just went over. See, this is just against a base of 100 at the beginning of 1995, but the Nasdaq actually just went over 5,000 in March of 2000. I actually have a former student who sold his shares, his Nasdaq shares, above 5,000, and it was only above 5,000 for a few days, and only a little bit above 5,000 Nasdaq. It had been down at 700 and had gone over 5,000, 700 and something, had gone over 5,000, and he sold his shares right at the very peak. And I know that because he would tell me it quite often. But it came out at a dinner party that his wife forced him to sell it because they were buying a house. So that was that was a good point. But in any case, this was a bubble that formed because people who had very negative views in the dot-com bubble couldn't express them. People like Warren Buffett or Abby Cohen. Abby Cohen's probably the most famous analyst on Wall Street over the last 30 or 35 years. She's sort of getting a bit long in the tooth now, but she was very famous even in the mid-1990s. I remember being a junior professor at Dartmouth and reading Abby Cohen's stuff saying that if you buy these dot-com stocks like pets.com that don't have hardly any sales, let alone any profits, then you've got rocks in your head. You should absolutely not buy them. And I ignored that and bought pets.com and it went to zero. So I should have paid more attention. But she's the best analyst in the last 30 years on Wall Street, worked for Goldman Sachs for decades as the most prominent partner. And she would tell her clients what not to do. Don't buy those stocks. Now, why didn't she tell them what to do? Why didn't she say you should short those stocks? You should short sell those stocks. Well, you couldn't short sell them. And the reason you couldn't short sell them was you couldn't buy the stocks because most of those stocks had only listed on the stock market a few months before or a year before, and they were locked up. When they listed on the stock market for the first time, they only sold 20% of the shares, and all of the rest of the shares were held by employees, but there was a lockup. They weren't allowed to sell their shares for 2 years. And the bursting of that bubble was the ending of that lockup. What burst the bubble here was that a lot of the biggest shares that had listed in this period were coming to the end of their lockup period. And suddenly the people who were holding those shares could sell them, and they could lend them to short sellers. And so the block on short selling, the block on that negative opinions that people like Warren Buffett had and Abby Cohen had, came to an end. And when that channel for negative sentiment opened, the bubble was burst. Warren Buffett's approach was different to Abby Cohen's. His was, I can create a .com company. He started the company called internet.com. How cynical is that? Internet.com. And listed it on the stock market. He just thought, if people will buy anything, why don't I just make it and sell it to them? It did have some assets and something going, but his attitude was, exactly as I said, if you buy anything, why don't I just sell you anything? Now, if we went along here, we would see, we can't actually sort of see it here in the S&P 500, but maybe I'll just tell you. You'll know that in the GFC, in the GFC, what happened basically was that there was a subprime crisis. The GFC, the global financial crisis, was really a housing subprime crisis. Really crappy mortgages, low credit quality mortgages, a huge amount of them, about $2.5 trillion of them were originated in the United States in the early 2000s, and they were packaged up. These crappy mortgages were packaged up into mortgage-backed securities, and then those mortgage-backed securities were turned into collateralized debt obligations. And some people came to realize that they were hugely overvalued, but there's no way to short sell them. There was no way to express the negative opinion. Now, this is what the movie The Big Short is about. It's an even better book than the movie. It's a Michael Lewis book. His books on finance are almost always fantastic. The best one is Liar's Poker from the early 1990s. But anyway, The Big Short is about Goldman Sachs finding a way to short sell those mortgage-backed securities and the CDOs. It was actually a CDO of a CDO, believe it or not, a collateralized debt obligation of a collateralized debt obligation called Timberwolf that Goldman Sachs really did create in order to be able to short sell those mortgage-backed securities, which they were sure were overvalued. And once they did that, once they created a way of expressing the negative opinion, the bubble was burst. So I'm really sort of bringing that out for you here, that if there isn't a block on negative opinion of some kind, then bubbles can't really form. Now, is there a block on negative opinion entering the market about AI at the moment? Well, not a very large one. There is to a certain extent. All of those AI stocks can be borrowed and sold into the market, and it's especially easy to short sell the S&P 500. You can use futures contracts to do that. It's the easiest thing in the world at any volume at a very low transaction costs, but it's dangerous. The market is volatile at the moment. People have been taken absolutely to the cleaners by stocks like Tesla. They thought Tesla was overvalued when it was worth $50. Next thing you know, it's worth $400. And you short sold it. And if you borrowed it at 50 and sold it into the market, now you've got, and you borrowed 1,000 shares, now you've got $50,000 in cash. But if it goes to 400, you got to buy it back at $400,000. And so there's no limit to how much money you can lose. This is the thing about short selling. When you go long, meaning that you buy shares, the maximum you can lose is the money that you put in. If you go short, meaning that you borrow shares and sell them, there's no limit to how much money you can lose. When you go long, then you can lose the money you put in, but your upside is unbounded. When you go short, the maximum you can gain is the price of the share, because it can't go below zero. And the maximum you can lose is unbounded. And in a volatile market, it's a risky thing. So some people who would like to short sell or who have negative opinions, it's just too risky for them. So that forms a constraint, but it's not a very large constraint. will we say that there's a constraint on negative opinions being expressed in the market in AI at the moment in the way that there always is in property, that there was in the dot-com bubble, that there was in the GFC? We would say there is not. There is not. There's a partial constraint. So we should bear it in mind. But we should also bear in mind that it's not like these previous episodes. All right, so could there be a bubble in AI? Well, opinions are highly varied. That's definitely true. And it's also true that there is a partial blocking of negative opinions. So there is, the necessary condition of the blocking of negative opinions is partially met. Let's just say that. And let's go on to look at valuation fundamentals. All right, I should speed up a little bit here. I'm going to. So let's have a look at the S&P 500. And here we're going back into the early 1920s. And we can see some things that actually look like bubbles and we know were bubbles. So this is the bubble leading up to Black Tuesday in the Great Depression. This is the Roaring '20s. That looks like a bubble. And it led to a very long bear market. Look, a lot of that bear market was to do with the Second World War rather than with the Great Depression. But nonetheless, it looks like a bubble followed by a long bear market. And that's really what it was. There was a long bear market here when we had stagflation from the evolving inflation here to the end of inflation in the US when inflation was driven out by Paul Volcker, the chairman of the Fed at that time, in the early 1980s. And that ignited this huge bull market that we've had, except for this episode. This is the dot-com bubble, of course, followed by a long bear market. Some of this is the GFC, this bear market, and this is the GFC here. But then, that leaves us where we are at the moment, up here. We certainly have had a long bull market, and those long bull markets are quite naturally usually followed by long bear markets. Are we about to head into that? Or is this the beginning of a super cycle? And this is what I mean by you've really got to have a position on how large AI is to think about whether this can extend well into the future, this growth in the value of shares in the US. If you think AI is no big deal, then you'll be thinking we're heading for one of these after this big bull run. If you think that AI, like I do, that AI is as big as the Industrial Revolution, but going to happen in 40 or 50 years instead of 220 years, then you think that this can go on for a long time. That's my position. But you have to have, as the background to that, the sort of conditioning background to that, a view. Can't avoid having a view. Now, here we're just looking at fundamentals of the market at the moment. The blue here is the S&P 500. And here we're looking at the forward price to earnings ratio. So it's how much investors are prepared to pay in dollars per dollar of earnings next year. So it's the price divided by the forward earnings. And this is a high value for the S&P 500. Being over 22, historically, it's been here in the mid-16s. And historically, we go a long way back before 2013. We could go all the way back to the 1920s. And we would see 16.5 to 17 as forward PE is the average value. And so it is well above that at the moment. So there's a very high valuation of the market. Does that mean that it's a bubble, or does it mean that there's high expectations for growth in shares? I think it's the latter. But it is certainly a high valuation, and that's why we need to be careful about positioning in the market. Now, if we break out the Magnificent Seven here, you can see that their valuations are much higher in terms of forward earnings. And then, it's better the price to earnings ratios are a good way of thinking about valuation. How much are people prepared to pay per dollar of future earnings? But a good extension of that is Robert Shiller, the Nobel Prize winning economist at Yale, developed the cyclically adjusted price to earnings ratio, the CAPE ratio. This is not what he won the Nobel Prize for, of course, but this is the CAPE ratio, and this is the best simple measure of whether the market is overvalued or not. Now, what we can see here is kind of disturbing, and I should say that the CAPE ratio, instead of using 1 year of data like our previous graph, this actually uses data from the previous 10 years. And it works out the CAPE ratio for all the stocks in the S&P 500 and the averages across them. But it takes the price today of the share and divides by the average earnings. So this is backward looking rather than forward looking, but it divides by the average earnings over the last 10 years, adjusted for inflation. And what you can see here, this does look like we are in bubble territory because this CAPE ratio has only once ever been higher. It is currently higher than it was on Black Tuesday in the Great Depression, a lot higher. It has been for some time. It's not as high as what it peaked at in March of 2022, 2000. Actually, it peaked a little bit earlier than March, but it's not as high as this peak in the dot-com bubble, but it's still very high. Now, part of that is just because earnings have been growing so quickly. Excuse me. And the price is reflecting that growth, whereas the earnings part hasn't caught up yet. So it's the price divided by the earnings. We've got the high current price divided by the earnings, which are low because they've grown so quickly. And that's partly overstating this. But nonetheless, it's again a statement that the market is at a very high valuation. If it's not at a bubble, it's certainly at a very high valuation. And we need to really bear that in mind. Here we're looking at the market cap of the Magnificent Seven. Actually, so this is the share of S&P 500 market cap that is the Magnificent Seven stocks, which are the stocks that I'm talking about here: Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Sometimes people include Netflix, and then it's the Magnificent Eight. But this has grown from being 7% of the stock market. There's never been a point in the history of the S&P 500 where the 10 largest stocks represent a higher fraction of the whole of the market. They become super dominant. Now we looked at here, this is what I mean about earnings growing super quickly in the S&P 500. If we go back to 2013, earnings in the S&P 500, earnings in the Magnificent Seven stocks are 1.2, this is their profits, after-tax profits. Earnings in the Magnificent Seven, 1.2 trillion. And now they're 20 trillion. And that's in the space of 12 years. And we've got to bear that in mind when we look at this. Over those 10 years, earnings have grown incredibly quickly. So what we're dividing the price by is a number that's down here, rather than a number that's up here. And that's leading to this thing being exceedingly high. But even taking that into account, I think that tells us that it's not a bubble, but it is still very high valuation. And we need to be aware of that. Here you can see this graph, and all of these particular graphs are from Yardeni Research. You should go there and have a look at the graphs if you're interested in these. Just go to yardeni.com or just put it into Google, Yardeni graphs. And this is a graph of the ratio of market cap to price. So, you can see here that the market cap of those 7 biggest stocks, 20 trillion, and the ratio of market cap to revenue, sorry, I didn't mean to say market cap to price, I meant to say market cap to revenue, 8. These Magnificent Seven stocks have got sales of 2.5 trillion, but they're worth 20 trillion. They're worth 8 times their sales, not 8 times their profits. This is 8 times their profits down here. Right? This is at the nada of the stagflation. This is 8 times profits. This is 8 times sales. So again, what's built into this is very high expectations of growth. And whether people are getting too excited about that, the possibility that there's a bubble forming just in the Magnificent Seven as opposed to the whole of the S&P 500, that's what this points to. But there's very high expectations of growth when you have valuations that are such a large multiple of sales. Now here we're looking at the actual earnings, the dollar earnings, and you can see the growth in earnings of maybe we've got a better graph than that. Yeah, here we go. So here you can see the growth in earnings. Oh, let me start off with this. This is the earnings this is the profits of the Magnificent Seven. So down here, 70 billion, and now 550 billion per year. Nearly 600 billion per year, 600 billion next year, all the analysts expect. The whole of the S&P 500, the market's zoomed up, but profits of the S&P 500, only 12, this is 2012 here, so only 12 and a half, 13 years ago, is profits of the S&P 500, 1 trillion, and now it's 2.4 trillion, the profits. So profits of the whole of the S&P 500 have really zoomed up. So just looking at the market and thinking it's really zoomed up, well, yeah, absolutely it's zoomed up. It's become incredibly profitable, those companies. And it's a question, an important question is just how long can that growth go on for? How big a part of the US economy or even of global GDP can the profits of the S&P 500 become? And we'll come back to that in just a moment. I don't think we're close to the limit. But you come down here and you can see this is the profits, 1.8, 1.9 trillion for the parts of the S&P 500 that are not the Magnificent Seven. And this is the Magnificent Seven. They're 600 billion up here. And now we're going to go on to a simple model. But actually, just before we do that, it's going to run an advertisement here, a short advertisement. Don't run off and get a cup of tea because you won't have time because it's only going to go on for about 30 seconds. This is a short advertisement for my Finance Education for Investors course, which is coming up on October the 13th. So this is a course to make you a far better investor. It does start at the beginning. So if you don't know anything about investing, don't worry about it. It's not mathematical. You don't need to worry about that at all. You don't have to have studied finance in the past, but it starts at the beginning and then it goes quickly. If you do know quite a lot about finance, don't think that you won't learn a lot on the course, because you will learn a great deal on the course. But it's about giving you empowerment so that you really understand investing and getting to much better outcomes. So it gives you an investment process. It takes you through a 10-step process of creating your own long-term strategy. It gives you all the information that you need, all the knowledge that you need of products and of different asset classes and of different ways of doing your tax planning and structuring. You learn about family trusts and self-managed super funds and corporations, corporate beneficiaries, about negative gearing and how that really works, and all of those structuring things. And you learn about all of the components, and then you put it together in a 10-step process over 10 weeks that we work through. And I'll give you the sort of structured opportunity and all of the knowledge that you need. And we take you through the creation and implementation of your long-term strategy. So it's very empowering, and it gets people to better outcomes. And it costs $1,600 plus GST. But I tell you, most people who take the course, the ROI on that course is somewhere between, over their full investment journey, for most of them, is somewhere between 100 and 1,000 times the cost of the course. And I'm really not exaggerating there. They get to far, far better outcomes. So it goes for 10 weeks. It's all online. You can watch it whenever you want. One video is loaded up as soon as you enroll, and then they drop every week. And then we also have, you get all of these materials. We have a website with all the calculators. You go to the website and you can watch all of the material, of course, and whenever you want. And we also have live Q&A sessions. So the Q&A sessions are every 2 weeks. So you send me your questions, or you can just ask me the questions in the Q&A session. So it's completely on demand, except for the Q&A sessions, which run every second week, and it runs for 10 weeks. So I know a lot of you who are watching have taken the course. You will agree that the course is terrific. I say without even a hint of modesty. But go to winterstone.com.au to get more information or to enroll. Or just email me about it. Okay, now we're going to have a look at, we're probably going to go for another 15 minutes here, but we're just going to have a look, and I know I've taken you through this before in webinars, so I'm just going to go quickly here. But what I want is to use another model here to really sort of bring out something more clearly about this, about what kind of growth expectations are really built into these kind of things. Where we have the ratio of where we have the price soaring up in that way, what kind of growth expectations are built into this very rapid increase in the value of the S&P 500. So I'm going to use this simple valuation model to do that. And what we have here is the cash coming out of the S&P 500. So I'm going to treat the whole of the S&P 500 like it's a single share. Now, all of the shares in the S&P 500, obviously there's 500 stocks in the S&P 500. But if you add up all of the shares in the S&P 500, they're worth $55 trillion, $55.1 trillion. And then we're going to look at how much cash is it generating. So we're going to look at the value and how much cash is driving that value into the future. And how fast does that cash flow have to be growing to justify the value? That's what we want to think about. Now, there's two ways in which cash comes out of these S&P 500 stocks. They pay dividends, and you can see that here. And these dividends go up relatively smoothly to about 660 billion per year. But even more cash than that comes out at stock buybacks. They pump cash out of the companies, especially the big tech companies, by buying back stocks. If you put cash into the hands of your shareholders as dividends, they have to pay income tax. If you put cash into their hands by buying back their shares, then they have to pay capital gains tax. And in most countries, capital gains is either zero or it's a half of income tax. And that's what it is in the United States. That's what it is in Australia. So this is just about tax. That doesn't happen in Australia, of course, because we have high dividends and low buybacks because we have franking credits attached to our dividends, something you learn about in my course, which is really important. And companies have to pay dividends to get those franking credits into the hands of shareholders. So this is not how it works in Australia, but this is how it works in the US. Most of the cash comes out as buybacks rather than dividends. And this is the two added together, the total cash flows. Now let's have a look at the numbers here. Now I'm going to assume going forward that this thing is growing at a constant rate. Of course, it's not growing at a constant rate. We can just see that by eyeballing it. But look, it doesn't really matter. By making this simple assumption, which doesn't really change anything, we're going to get to something really powerful. So we're just going to do that. Okay, how much cash is coming out? Well, 1.12 billion as buybacks. This is what we're expecting over the next year. That's down here as buybacks. And 680 billion as dividends. We're expecting both of these numbers to grow a bit from where they were last year. Now we have to subtract an amount which is not cash coming out of the companies, but cash going into the companies when they sell new shares. So to get the total amount of cash. And so if we owned the whole of the S&P 500, we would be getting $1.72 trillion per year as cash coming out to us. So what do we got? We own the shares. They're worth 55 trillion, sorry. We're getting 1.72 trillion in cash. We're getting a cash yield of 3.1%. And we're paying 32 times next year's cash flows. Now, this is a measure of how fully valued or overvalued the market is. This is a very high number. To be paying 32 times next year's cash flows, you really have to expect a lot of growth to pay that much. Ordinarily, this would be more like 25 times cash flows would be a more typical number for the US stock market. So it's fully valued or overvalued at the moment. I don't think it's a bubble. That's just another level. But it's certainly fully valued, and you need to be cautious about that. Now, I was saying just a moment ago, how much can these cash flows, these US S&P 500 cash flows, continue to grow? And I was comparing it to global GDP. See, this number here of the cash coming out of the S&P 500 is 1.3% of global GDP. Now, could that number double? Could it grow to 2.5% of GDP, global GDP? Yeah, that could definitely happen. And it wouldn't raise an eyebrow, really. It would raise plenty of eyebrows, but it wouldn't have any effect. No one would be able to push back on it. It's not like if that was Switzerland doing this or Singapore or something, people would take measures against them. But it's the United States, right? What are you going to do? If the proportion of global GDP that's flowing to the shareholders of the S&P 500 doubles as a percentage of GDP, global GDP, what's anyone going to do about it? They're not going to do anything about it. They're not even going to be able to put higher taxes on those global US companies without meeting resistance from the White House, from the United States. We're seeing that right now. Could this grow to 3, 4, even 5%? Absolutely it could. Will that happen? in the AI era? It could easily happen. That could easily happen. There is no constraint here, or not a meaningful constraint on how much these cash flows could grow. All right, let's go forward here. So 3% cash yield. And what we worked out here so far is we've said we think the cash flows are going to grow at a constant rate. Of course, they're not, but it doesn't matter. It's a simplification that really gives us some good, powerful results. We think there's going to be 1.72 trillion next year, and then they're going to grow at a constant rate, the amount of cash coming out. And we're paying 55 trillion for those future cash flows. That's always what you're paying. That's always what you are buying when you buy shares. You're buying future cash flows. Now, it might be that you get the cash by selling shares, but that's just, the shares are just packaged up future cash flows. So these cash flows in the future are worth this amount of money today. Now, if we just sort of make that assumption, this willingness to pay 55 trillion is really driven by two things. How much we think the cash flows are going to grow, and also what is our required return? How much return do we need on our investment for the time value of money, for the riskiness of the shares, and for how hard they are to buy and sell? These are the things that really drive valuation. Growth here and this time value of money down here. But anyway, I didn't mean to go too much into this sort of modeling notion. What I really want to bring out is, what does this G have to be to justify that valuation? How rapidly are we expecting cash flows to grow to justify that valuation? That's what we want to get to. Because if this number is too big, then the market is overvalued. If this is an unrealistically large number, that what the growth, the expected growth that's baked into the current level of the S&P 500, then it's way overvalued. So let's see what it is. Let's work it out. Now, the way that we can work it out is that once we make this assumption that cash flows are growing at the same rate, we can do this. We can do this simple thing, that in any period of time, from here to here, from here to here to here to here to here to here, in any year, these two things have to be equal to each other. It has to be that the required return and the realized return have to be equal to each other. Now, our required return, investors need what they could get on government bonds, plus compensation for risk, the market risk premium, the extra return, the premium for bearing the risk of the market risk premium. They need the return they could get from risk-free government bonds, plus extra return for the stock market, plus something for shares being illiquid. Now, shares are not very illiquid, so I'm just going to set this thing at 0. If we were investing in property, if we're doing this for property, this would be a big number. But shares are not illiquid, so I'm just going to ignore that. Maybe I shouldn't have put it in there in the first place. Doesn't matter. This is the required return. Now, this is how we're going to get the return. This is what we're thinking when we buy the shares, but this is how the return will be realized. We will get a capital gain, and that capital gain is just going to be the same as the growth rate in the cash flows. As the cash flows grow, as our expected cash flows grow, the value of the shares is going to grow, and we're going to get a yield. Now, we know what this yield is. This is 3%, 3.1%. We said that a minute ago. And we know what this is. I'll show you. And we know what this is. This is the thing that we're going to pull out from seeing that the required return and the realized return have to be equal to each other. It's going to show us what this is. It's going to show us what growth rate is baked into that valuation. And that's a very helpful thing for telling us about whether the market is overvalued or not. And the reason we can do this is our simple assumption that cash flows are growing at a constant rate. This is what I mean by that's going to deliver us something powerful. That simple assumption, which doesn't really change anything. It just gives us something. So we set these two things equal to each other. Now I'm going to take out inflation. So there's inflation in the growth of cash flows coming out of shares, and there's inflation in these treasury bond yields. So I'm going to take the inflation part out. Here's expected inflation. It's in the future, so it's expected inflation. I'm going to take that out, and we're going to look at the real return on treasury bonds, the real yield, and the real growth rate, so with inflation taken out. So what do we got? The market risk premium plus the real yield on government bonds is equal to the growth rate of cash flows and the market yield. The yield, the 1.72 trillion divided by the 55, the cash flow yield. Now we know what that is. We know it's 3.1. I'm going to show you what these two things are, and it's going to tell us what this is. And then we're going to make a judgment about whether that's unsustainably, unrealistically high. And I'm going to say one or two other things, and then we're going to be finished. Then I'm going to answer your questions. So let me just show you this quickly. We saw already this is 3.1%. We saw that here, right? The 1.72 trillion next year against a market cap of 55. We did that already. The market risk premium, that's just the historical value. If we go back over the last 125 years, you would see that the after inflation growth or return on US shares has been 6.6. The real return on US shares, including dividends and buybacks, or dividends and increase in the share price, the real return to investors has been 6.6, and the real return on 10-year government bonds has been 1.6. So the difference between those two things, the real return on government bonds and the total return on shares, this thing here actually, the total return, the realized return on shares, that's been 5% over the last 125 years, the average. So that's the value we're going to use, 5% here. And then this, the real yield on US government bonds, we can just see that by going to Bloomberg. If we go to Bloomberg, you can see the yield on 10-year government bonds. This is where they are. Well, this is where they were about 2 hours ago when I made this slide. 4.23. If you take out expected inflation, 1.8. You know, there's treasury bonds that are not protected against inflation, and there's treasury bonds that are protected inflation. The only difference between these bonds and those bonds is that these ones get inflation protection, inflation compensation. The principal of the bond and the coupons and the repayment of the bond all go up with inflation. And so after taking out inflation, 1.8%. You see how high this is? See how much this goes up? I should just point this out to you. This is the fear of a debt crisis in the US. People don't need a lot of compensation above inflation for holding short-term bonds, but for long-term bonds, they're really worried that there's a slow motion debt crisis in the United States. That slow motion train wreck that is the US fiscal situation, the budget deficits of 6 or 7%, that slow motion train wreck at some stage turns into a fast motion train wreck. And they're worried that they'll be holding these long-term bonds when that happens, when people start dumping US debt. And they need compensation for it. This is way up above what it would be if people weren't worried about the unsustainable amount of spending by the US government. But in any case, what we need here at the moment is this 1.8. So 1.8, we can just see that in the market, 5%, that's historical. 3.1, we can see that in the market, that's the 1.72 divided by 55. And that just tells us what this G is. What's baked into the S&P 500 at the moment is the expectation that cash flows will grow at 3.7% in perpetuity. Now, that's a very high number. So we would expect, if we thought that this was just going to grow at the same rate as the US economy, we might expect this to be more like, let me just get a pen going here, more like 2.4%, something like that. Now remember, this 3.1 is the 1.72, the cash flows, divided by the 55 trillion. So if that's going to go down, this has got to go up. If that goes down 1.3, this has got to go up to something like 4.4. Or if we wanted this to go even lower, that would have to go up more. Now, for this to go up by a third or so, this would have to go up by 600 or 700 billion. Let's say 600 billion. Or this would have to go down by about 10 trillion. to get to a higher yield to make this a more sensible number. Now, the thing is, this 600 billion, that's about how much the Mag 7 are spending on CapEx next year. You know, it's not that they're not making enough money, it's just that they're reinvesting the money. You know, if they stop spending so much on CapEx, they could amp this up. This could go up tomorrow if they spent less on CapEx. Of course, if they spent less on CapEx, we would expect this to be a lower number. But this is a high number, and it's a high number because of the spending on CapEx. So what I'm pointing out here is that this 3.7 is very large, and it's reflective of this and also of the opportunity. I don't think it's unrealistic. I do think it's sort of very highly valued. And looking at the S&P 500 at the moment at 6460, that's a high number. And it doesn't make me sort of think it's undervalued. It means it's fully valued or maybe even overvalued. But I don't know. But I definitely don't think it's a bubble. And when I look at this, I don't think, given the background of how transformative I think that the AI revolution is going to be over the next 40 or 50 years, as we talked about at the beginning of the talk, I don't think this is unrealistic. I think that these cash flows can jump up quickly in the next few years. And then this thing, once this jumps up, so long as this doesn't jump up too much, this will go down to a more sustainable number. You know, could this total cash flow, this 1.7, could this grow to 3.5 or even to 7 trillion? In which case it'd be something like 5% of global GDP. I think that can happen. You know, the United States is going to be the absolute epicenter of AI. And I think it's going to be hugely transformative in a short period of time. Does this look unrealistic? I don't think it is unrealistic or highly unrealistic. It doesn't lead me to think that you need to get out of the S&P 500 rapidly. But look, I do think all of the things that we've looked at means that it's at high valuation. Right? It's like you don't look at the S&P 500 at the moment and think, wow, that's a big buying opportunity. You look at the S&P 500 at the moment and you think, should I cut back my exposure? Is that so fully valued or overvalued that I should cut back my exposure? I don't think that's not where I'm at. I'm thinking big exposure to US shares to get full exposure to tech in the 21st century, not just AI, but tech in general, and the US being the tech engine of that. So the biggest mistake that investors made in the 20th century was to be underweight US shares. You don't make that mistake in the 21st century. Is the S&P 500 so overvalued at the moment that you want to cut back your exposure? No. Is it a bubble? No, it's not the dot-com bubble. Is it fully valued or even overvalued? Perhaps, right? It's definitely fully valued. Is it overvalued? Perhaps. Is it so overvalued that you want to cut back your exposure? No. Be a buy and hold investor. Don't kid yourself that you can time the market. Okay, let's have a look at a couple other things here, and then I'm going to go to your questions. Look, there's some things to be worried about in the market. One is President Trump's assault on the Fed. And I call it an assault because of the way he's treating Jerome Powell and one of the governors, Brown. You know, the case that he's making against Governor Brown is just a complete beat up, basically. And look, and the markets won't put up with this. If President Trump puts his own governor in, once Jerome Powell's term comes to an end in a few months' time, if he puts his own governor in, and in the face of inflation that's being driven by the tariffs, you know, an inflationary impulse that will pass, but inflationary impulse that is being driven by the tariffs, President Trump's appointee cuts the short end of the yield curve, cuts short-term rates radically, then that inflationary impulse can become permanent. You know, it's a very dangerous thing. And bond investors will revolt. You know, they're already super worried about the US level of spending and the potential for a debt crisis in the United States as the level of government debt rises and rises. And if you put into that a Fed that doesn't take the control of long-term inflation seriously, there'll be a bond market revolt. Now, I think President Trump is wise enough, and he's shown this in his previous administration and even earlier in this administration, he's wise enough not to take on the bond markets. There's only two people President Trump can't take on. One is the Supreme Court, and the other is the bond markets. Otherwise, he is unconstrained. But I think he'll be wise enough. But it is definitely a danger, something to worry about. Another thing to worry about is whether we're entering an AI winter, and whether everyone saw ChatGPT 5. It was very underwhelming. ChatGPT 5. We saw the ChatGPT 4 sort of launch this 65% increase in the S&P 500 over the last 30 months. ChatGPT 5 was very underwhelming. People are worried that the scaling laws, which have been delivering such incredible increase in AI power, may be coming to an end. Look, I don't know. And nobody knows. Obviously, there's many thousands of people who know more about AI than me, maybe even hundreds of thousands, but nobody knows whether those scaling laws are coming to an end or not. But we may be entering into a flat spot with AI. And it's also true that the CapEx by Mag 7, that 550 billion that the Magnificent Seven share companies are going to spend on capital expenditure next year, it is just a historical fact that it's just in the historical record that companies, on average, companies who spend more on capital expenditure have lower returns in the future. And so it's really something to worry about, whether they're keeping all of that cash that they are generating with their high growth and their high sales and their high margins in the company and spending it on NVIDIA chips and on hyperscaling and data centers, whether that is going to work for them or not. That is genuinely something to worry about. And if you just sort of say, oh, this time is different, and how many times have we heard this time is different? That CapEx has got a big question mark over it. And AI is CapEx intensity. Now, these are things to worry about. I told you already about how transformative and important I think AI is going to be and what a huge boom it's going to generate. But those are things to be concerned about. It's not a bubble. Keep high allocation to US shares, but be cautious. And being cautious means this. It means being fully invested. If you are fully invested in US shares, if you've got your full strategic asset allocation, something like 20, look, I'm not telling you what to do here, but for me, I want to have something between 25 and 30% of my investable assets in US shares. And if you're fully invested, stay invested. Don't kid yourself that you can time the market. And trying to time the market is just a great way to realize capital gains early and to spend too much time in cash. And both of those are just a losing proposition. If you're not fully invested, if you're underweight, then just get back into the market slowly. You need to think, how much I'm going to reinvest every month or every quarter? Just extend that period a little bit. This is what it is to be cautious. You're going to dollar average your way back into the market. Just extend the period over which you're going to dollar average your way back into the market. That's what being cautious means here. Now, it's also true that if you're underweight, you're going to have trigger points. And if the market moves down, if President Trump engineers a crisis with the bond market and the market moves down, for instance, then you're going to bring your averaging in. You're going to bring it about more quickly. As the market moves down and hits your trigger points, you're going to get fully invested more quickly. Now, I would extend your trigger points, but say that you don't have any US shares. I would extend your trigger points over a 25% decline. Ordinarily, I'd say 20% is plenty. But at the moment, be cautious and divide it up into something like 6 parts and just say, I've got X dollars I need to invest. I'm going to invest 1/6 of them. If the market moves down here, another sixth, another sixth, another sixth, another sixth. Now, you can see these increments getting smaller as we go along, or getting bigger as we go up here, getting smaller as we go down. That's perfectly natural. The further the market goes down, the more value there is to you, the more rapidly you should be getting fully invested. If you're not fully invested, if you're fully invested, stay invested. If you're not fully invested, then you've got a dollar average back into the market. Be cautious about that. Put your trigger points in place. If you have the opportunity to get fully invested, hit your trigger points. You're sequencing into the market over some period of time. But if the market falls a lot, then you're going to go all in. If it falls enough, you're going to speed this process up. Don't forget about my course. Let me just remind you about this again. The course is coming up on October the 13th. But you can enroll at any time and you'll access the first class and other materials. And then the course starts on October the 13th and runs over 10 weeks. One class every week, and then the Q&A sessions every second week. People love the course and they get a huge return on investment from it. Many of you have taken it, and you know that that's correct. All right, brilliant. So thank you for listening to all of that. As I predicted, one prediction was correct, which is that I would run over time, even more than predicted. But I hope you found that useful, and we will send you the slides and a link to this recording.